Well, it's been a week in which investors have asked questions about the future of artificial intelligence after a Chinese player brought an AI chatbot to market for a staggeringly small amount of money. But Mark Zuckerberg, the founder and CEO of Meta Platforms, says he remains bullish. Zuckerberg told analysts he expects the Meta artificial intelligence assistant, known as Meta AI, to become the world's most commonly used AI tool this year. At Microsoft, the company said the demand for its cloud computing business continues to outpace its ability to build data centers fast enough to keep up with that demand. Let's talk about all of this with our featured guest of the morning. He's Nathan Thooft, Senior Portfolio Manager at Manulife Investment Management. Nathan, thanks a lot for joining us. What do you make about this reconsideration of the potential of AI, particularly, I guess, the financial potential of AI, given the news from DeepSeek earlier this week?
Well, it certainly sent some shockwaves through the industry. But at the end of the day, when you look at the reports we've seen so far, both from Facebook and from Microsoft, they're not only telling you that they continue to invest in AI, the numbers suggest that they're investing in AI. So they don't seem to be particularly concerned because they're still raising their CapEx expenditures on AI developments. And so while I think there's probably some real breakthroughs with DeepSeek, let's keep in mind that technology in general, over the entire history of going back to the 1950s, has very rapid developments, and things get faster, things get more efficient, things get quicker very quickly. So these are the types of announcements you would expect to happen with AI, is further advancement. But at the same time, the big US tech companies aren't pulling back on their CapEx spending, which suggests that they have a lot of confidence that AI is still going to drive earnings growth into the future.
Microsoft's news is interesting this morning, or the commentary from Microsoft. The stock is actually down because the company says that growth in its cloud computing business, which is really what Microsoft is all about these days, will be slower than hoped for. It's still more than 30%, but that is enough to disappoint the market. And the reason that Microsoft flags for this is that it simply cannot build data centers fast enough to keep up with the demand for its cloud computing services. We're just looking at Microsoft stock in the pre-market trade. It's down about 4%. What is your takeaway from that type of guidance as well? We also had, I believe it was the CEO of Oracle telling our colleagues at Bloomberg News at the Davos event, the World Economic Forum, that it also can't build out fast enough to satisfy demand for its products.
Yeah, I mean, you can take it a couple ways. I mean, certainly it's disappointing that you can't keep up with the build out of the infrastructure, but at the same time, these are some very strong numbers, and the miss on the cloud growth was fairly narrow. And so the size of growth we're seeing and the actual delivery of earnings on a quarter-to-quarter basis still look very, very strong. Obviously, investors do react looking at the longer-term view of, is there any penalization of, this restriction on infrastructure built out as it pertains to future growth projections. And so that's hurting the stock a little bit today. But we got to take a step back here and look at how powerful the earnings profiles of some of these tech companies continue to be, even if they're missing on the margin, such as Microsoft did overnight.
So with all of that in the background, what role does large cap tech have in your portfolios right now?
So for us, we still like the tech companies, but we also recognize that there's other opportunities in the market. So what we're advocating for over the last several months is just recycle some of the wins you have in technology. Not to be underweight technology, be a bit more neutral technology stocks, but recycle those into other areas of the market. And the reason for that is the multiples on tech are very high. The sentiment and the technicals are really strong, and so people are really loaded up on these names. So when you get these uncertain environments or this uncertain news, such as DeepSeek over the weekend, that causes a little bit of pain because valuations come off of very stretched levels. And so there's a bit more risk in the tech sector right now, just given where valuations are. And let's keep in mind, we're seeing a broadening of breadth in the market when it comes to participation. It's not just tech that's winning anymore. In fact, technology stocks were only the 5th best performing sector last year in the US. And so we are seeing more opportunities versus just large cap US tech stocks, but we wouldn't be underweight those names. We would just be recycling our wins into other areas of the market.